we need to talk about target date funds. This is Kate Phillips with Total Wealth, and I was appalled to learn that the most popular investment now in 401ks, I think it has been for a while, but holding more money than any other investment in retirement accounts is now the target date fund. Why is this a problem? Well, you'll know by the end of this video what the myriad of problems are. I'm going to try to keep it like shorter than a book, shorter than an hour, because there's so many problems. And I'm going to also let you know what you might want to do instead, or what direction you want to go. They have been the most popular investment for a while as far as new investors coming in. And about 8 years ago, I did research on target date funds. I wrote a series of articles for for an investment advisor's blog, and I was, appalled by what I learned. They tend to far underperform. They have way more risk than people understand that they do. And the first time we really saw these target date funds fall apart was in the stock market crash of 2008, 2009. This was during the Great Recession. And, the stock market lost 40% plus, I think something like 44%. And target date funds lost about the same, depending on the fund. They were losing, 35, 38, even up to 50% losses in people's retirement accounts. And these were supposed to be like retirement funds. They were supposed to be safer, especially if the target date funds, if the retirement date was sooner. And if you're not familiar with target date funds, they're also called life cycle funds. They are the mutual funds that people choose, and they've got like a retirement date on them. Like, this is for people that are retiring, in or about, let's say 2030, 2040, 2045. Usually you can buy target date funds, and, they exist in about 5-year increments, and people choose the date that is closest to when they believe they are or desire to retire. And the idea behind the target date funds, how they are sold, is, well, you should be invested in stocks and bonds. And then as time goes on and as you grow older, when you're younger, you can have more stocks, more securities, you can handle more risk. And then as you grow older, you want to, transition over time more into the bonds, more into the income funds. Bonds are used for income. And, this sounds good. It sounds logical kind of on the surface before you start poking it a little bit. And, so they sounded great. Oh, you're going to reduce the risk. It's going to be managed for you. The sales pitch is you just do nothing. You just put your money in and you just do nothing. You don't have to worry about it or think about it or make adjustments. We're going to do all that for you, or the fund is going to do all that for you automatically. Sounds great, right? So people were putting their money in these. And not just people putting their money, but employers were designating. There was a congressional act passed in 2007 that designated target date funds, along with balanced funds and managed funds, as the only 3 places that an employer could default, like the default investment for that 401k, and only if the employer used one of these default investments would they be protected from liability. So in other words, if they put money into a retirement account and the next year the retirement account has lost, 30, 40, 50% of the money, too bad. You can't sue anybody. You can't, you can complain, but nothing's going to be done because these were like protected investments. And the really like nefarious thing about this change happened in 2007. And prior to 2007, it was stable value funds that were the default, or one of the default, maybe the only default investment. Stable value funds, very safe, very reliable, not great returns, sort of like money market funds. You may not be familiar with them because they're primarily used in institutional investments, pensions, that kind of thing. They're sort of like money market funds. There's an insurance component, and they tend to they've historically returned about 2% per year. So they've performed a little better than money market funds, maybe not quite as well as bonds, but they tend not to lose money even in, bad economic times and volatile times. So instead of money going there, after 2007, what happens in 2008? We've got a big stock market crash, and all of the sudden, like, people have no recourse to having these big losses in their retirement accounts. Yeah, not great. So why are they so risky? There's a number of reasons of why they tend to underperform. Um, they have tended not to be well managed, oftentimes not even managed according to, kind of the sales pitch. We're going to reduce your risk. Maybe not so much. They tend to have high fees, and the fees, a lot of them are not maybe easy to see. If you've got one of these in your retirement account, you probably have, 401k fees and administration plan fees, and then you've got the management fee, and maybe the management fee isn't all that high, but these tend to be funds of funds, so there's probably baked in fees and baked in costs to the funds that are comprising the fund. It's sort of like sausage, and not really high quality sausage. I find that Wall Street firms do a great job of, advertising and educating people on the advantages of investing and the advantages of compounding. And you want to save and invest, and you want your money to compound over time. And it's kind of like telling somebody all about the advantages of grass-fed beef. It has these nutritional advantages, and, maybe there's environmental advantages, and then you sell them bologna. So they're not really getting the advantages of the thing that they think they are getting. And so it gives this false sense of security. That's one problem. But anyway, you have these high fees, and that's one reason why they tend to underperform. They tend not to be managed super well. One of the problems with the management, and this is actually baked right into the dough, baked right into the bologna, is that if you have an actively managed fund, you can, hopefully the manager is paying attention to the economy. They are paying attention to, political instability and to other factors happening in the environment. With these target date funds, they're literally predetermined how they are going to be invested, and the strategy that is predetermined has to do with dates. It's according to your age, according to the date, the retirement date. So there's no flexibility or sensitivity to economic factors, to political factors. These funds are just going to do what they do. This predetermined strategy that if there's a pandemic, they're not going to adjust. If there's a war, I don't know if wars or pandemics ever happen, but if they do, they're not going to adjust according to this particular strategy. So And then also everything, with the sausage, with the bologna, everything's all tied in together. So you might have economic conditions where you're like, wow, things are getting really volatile right now. I would like to, have more safety in my portfolio. Too bad, it's all tied together. It's not like you can pull out the tech and the last year we have had obviously a rising interest rate environment. The Fed is raising the interest rates to address inflation, and rising interest rates are bad for securities and bad for bonds. Guess what? We still have inflation. Jerome Powell is still making, sounds, noises, conversations about continuing to perhaps we may see interest rates go up even higher yet until we see inflation under control. Until we're truly done with inflation, we're going to see the interest rates rise. So they may have another bad year. I think it's kind of likely. There's a lot of talk about recession, and we could argue whether or not we've been in a recession already, so whether we're looking at going into a, worse part of it or just entering into a recession. We could debate that. But there are leaders and CEOs who are anticipating this is going to be a tough year for multiple reasons. I'm not going to go into all those reasons, but just to say that that with multiple things going on in the economy, there is anticipation of either a recession or perhaps a worsening recession, depending on your definition. And target date funds will not do well. So, and with the whole stocks versus bonds, and we just need to adjust, the stocks versus bonds and that ratio, that's a big fat assumption. That's a big assumption that the best assets are the stocks and the bonds. It's sort of an assumption that those are really the only two things worth investing in. Why is this assumption put out there? Well, of course, it's part of the narrative of Wall Street, because this is what the brokerages sell. They sell stocks and bonds. So they're not going to talk about, real estate or life insurance or other types of perhaps alternative investments that maybe would do well in certain environments. They are going, they want you to just be thinking, well, stocks and bonds, that's what I should invest in. And you just adjust the stocks and bonds according to my age. And of course I want them to do this for me. Easy. It's the easy button, the automatic button. And that is why people continue to buy target date funds in spite of the fact that they have underperformed. They continue to underperform. They were a complete mess during the, I think I already mentioned that, during the Great Recession. There was a congressional inquiry that was triggered. They performed so badly. And when the congressional inquiry was triggered, I did some digging into that, again, controlling the narrative. Well, just because somebody's target date fund was 2010, we weren't managing money to retirement. We were going to manage money through retirement, assuming that those people still wanted their money invested in the stock market even after they were retired. So, it was a lot of rhetoric, and of course nobody was ever held accountable for all the huge losses in the retirement plan. I'm glance at my notes here. Yes. So, yes, very important to know is that so people had this false sense of security. One reason why I am suggesting you look into maybe not leaving your money in a target date fund. You're probably being told, stay the course. That is what all the money managers, want you to do, is just stay the course. But what if it's not a good course? I do not think we are going to see target date funds bounce back in the next year or two. And so if you're staying the course, you may find it very disappointing. And I want to show you something mathematically. It's very simple to understand, because these are not going to gain along with the S&P 500. Probably not, because they are invested in multiple things. But let's say you have $100,000, or do the math, take off a zero, add a zero, whatever. Let's say you have 100,000 in a retirement account and a target date fund, and it loses 20%. Well, you don't need 20% gain to get back. You're now at 80. You've got to have a 25% gain to get back to 100. Let's say your target date fund has lost 50%. And by the way, I saw target date funds that had lost 50% and more in 2022. It is absolutely appalling. Major company. So I saw funds that had lost, 37, 50%, even up to 60%. If you've lost 50%, you're now at 50,000. You need a 100% gain to get you back to where you started. Oh my gosh. So if you're in one of these, what do you do? What do you do now? Well, you fire whoever put you into that. Well, I won't say fire them, but you want to have your eyes open. The whole promise of target date funds is they're easy and they're automatic. They don't want you paying attention they just want you to stay the course. That is making them nice and steady money while your account goes up and down, and you take the risks and you take the losses. And losses can be part of investing. I'm not saying don't ever take risks by any means, but again, they're sold as something that people believe is going to be safer than they actually are. And they're quite inflexible. So you want to be involved. You want your eyes on it. If you are in a target date fund, I want you to go and see how it has performed. And maybe it's one of the good ones. Maybe if it's been doing better than the S&P 500 or better than the Dow Jones, I would say, hey, maybe you want to stick with that. Maybe it's a good one. I've just seen in the last few weeks, as I've started poking into this, like some really, really poor performances. And even though past performance is no promise, it's, doesn't indicate past results do not indicate future performance. There's no indication that a lousy target date fund that has been underperforming is going to do better in the future. There's no indication of that. You want to be informing yourself of the options. You need to, unfortunately, shake off the idea that there's any such thing as an easy button that's going to have good results. I mean, you can put your money into a savings account, into a bank CD. You're going to get reliable results, but probably not the results that you are hoping for. And so if you want better results, it's actually time to get, educated and involved. It might be time, as I mentioned, I don't have high expectations in the next year or two for target date funds. It might be time, especially if you are over 50, to look at, there's a certain type of annuity that will stop the losses and will still allow for gains when the market gains. I've got some friends that are specialists. I don't sell them. I don't sell annuities or any kind of investments, but I've got friends that specialize in that who have done a great job for their clients. So if you want an introduction, reach out to me, let me know. You can leave a message or hunt me down on Instagram, Facebook, etc. You can find me or leave me a message, or you can email me at kate@totalwealthcoaching.com. kate@totalwealthcoaching.com. Those are all the places you can find me. It is time to get properly diversified. It's time to get educated and realize maybe you've been taken for a ride, and you've been sold something that, go and look at how it has performed. And not just in your portfolio, but you can find the ticker symbol, you can go to Morningstar, or oftentimes you can Google and see, what the performance has been, and take a look and compare it. Compare it to, as I mentioned, maybe what the S&P 500 or what the Dow Jones has done. And maybe you're older and maybe you are wanting something that is more conservative. So maybe you want to compare it to something that is very conservative. And I mentioned the Dow Jones because it is typically more conservative. Or, there are things that you can compare it with to see how it has done. I also want to absolutely invite you, if it's before or around March 1st, I'm doing a little mini course, the Money Momentum course. It is 6 weeks, actually 7. I threw in this coming Wednesday, February 22nd, I'm doing a bonus training on financial trends of 2022 and 2023. And then I've got the 6 weeks Money Momentum course that's going to talk about the basics of wealth building. And I'm using my MAPS framework of, the mindset and the thinking and what are the actions and the habits. And then we're going to look especially at strategies. We're going to take a couple of weeks looking at investments. We're going to look at real estate in one of the weeks. And it is a great introduction to wealth building course. I will leave the link for that in along with my email address. Wouldn't that be good? I'm kind of new with YouTube, still trying to figure out what do I say in these videos? Like and subscribe. Yeah, I always forget that part. Like and subscribe if you found this valuable. Share it if you would. And I will put in the description, and I'll put it in a comment, and I'll pin it. You can check out Money Momentum. It's a bite-sized course. This is an introductory price, crazy pricing. So check it out. You won't be able to take this in the future at the same price. So check out Money Momentum. And if you are in a target date fund, yep, it's time. I would highly recommend taking this course. You'll learn about different asset classes, the risks and rewards of different asset classes. I am an educator. I am not a salesperson. I have no investments to sell you. And I think it's one of the problems with the industry is that we have to, people are trained to go get investment advice, typically from somebody who is selling them products. And they may be awesome advisors, or they may not be. It really depends. I know some great advisors that work on commissions and fees, and so you can get good advice, but everybody has their biases. And so we've got to be educated so we can maybe recognize those biases and say, gee, does this feel like the right path for me? Because ultimately, nobody will care more about your money than you. Would love to know what you learned. Leave me a comment, like and subscribe. Have an awesome rest of your day. Remember, you are powerful, you are prosperous, and you are free. Bye-bye.